Hey everybody, it's Margie Burkett with Douglas Elliman. I'm here today with Larry Matarasso, who is our mortgage guy from CrossCountry, and we're going to talk to him about mortgages and common misconceptions. Larry, what would you say is the most common mistake that people applying for a mortgage make?
Well, Margie, thank you. I'd say people make a lot of mistakes. The number one mistake I would say is listening to the wrong person. Number one, you have to pick a mortgage expert. Pick the right person. Hopefully it's me, but somebody that you trust who knows your situation. Too often what we have is home buyers are listening to people in their life who mean well, but may not have all of the information. They don't know what your specific financial situation is, and they're not experts in the mortgage business. So your mortgage loan officer knows exactly what you can afford. Now you have to listen to yourself. That's the number one thing. Number two thing I would say is people relying too much on consumer credit reports, such as one with the abbreviation CK. I don't want to get in trouble here, so I'll say CK. People come to me, they say, this is my score, and many times that score that they have is not their accurate mortgage credit score. That the real mortgage credit score is somewhat different, in many cases lower. So not being educated on their credit would be another thing. And also not having an accurate idea of what it costs to get into a home, the down payment required, the closing costs, and the monthly payment. So not having accurate information is really a problem for buyers.
And why are people so reluctant to get that information and to call a mortgage broker and to get pre-approved? They go out, they look at houses before they even really know what they can afford. And I wonder why they are so reluctant to do that.
Well, I think a lot of what is out there in terms of mortgages and in terms of housing is from an emotional standpoint. Mm-hmm. So it's made to look on TV very quick and very easy, right? For realtors, we look at 3 houses. If we're on HGTV, we find the right house, we make an offer, we close in 30 days. Real simple. From a mortgage perspective, you push a button, a guy in a red golf shirt gives you a mortgage, and you have a mortgage. Much more involved than that. And I think it's just too easy to look at things from an emotional standpoint, as opposed to digging deep in your brain and analyzing it, because that takes a little more work, and also finding the right realtor. A lot of times what people will do is equip themselves with the wrong real estate agent who deals with things 100% from an emotional basis. The really good realtors, and I'll put you into that category, Margie.
Thank you.
Look at things from both an analytical standpoint, which is necessary because there's a contract involved, and also from the emotional sense in that they have to love that house that they're going to buy. But it has to work in terms of finances, in terms of timing. So it's not rocket science, it's not brain surgery. I said rocket science, I probably shouldn't use that word, but there is more involved to getting a mortgage than people would like to believe. So that's what I would say.
Right, it's a big deal. I mean, you're borrowing, tens of thousands, hundreds of thousands of dollars. It's a big deal. Of course, people have to be properly vetted. Now, we all know a pre-approval is not a commitment. The commitment comes at the end. Or when you're about to close, a real commitment that the mortgage is going to go through. What would you say is the most common thing that makes that not happen?
Goes back to the instant gratification that comes with these mortgages, where you'll see, again, push button, get a mortgage. Yes, you can go online and get an instant pre-approval, but it's really not worth much unless there's something to back it up. So people will make an assumption that they're pre-approved without having their mortgage expert vet them, and I mean this in a positive manner, to look at their income documentation, look at their assets, analyze their credit with them, and that's part of getting a real pre-approval as opposed to a fake one. So
you have to do a deep dive. It can't just be how much money do you make and that kind of thing.
Yeah, there's several layers to it. I mean, you can get the most basic of a pre-approval based on just numbers that you type into a website, but a real pre-approval comes with a full credit report with 3 scores that has all of the data needed to get the proper credit report. It comes with accurate information in terms of your income and employment history, your assets, everything about you. your current housing payment, all that information has to be accurate. So a smart loan officer with a complete pre-approval is going to take that information, is going to enter it into an AUS, an automated underwriting system. Typically that's a Fannie Mae or a Freddie Mac underwriting system, and that does an analysis on the loan. And if you get an approval through that system, in the vast majority of cases, that's a very, very good sign. Now you have to look at what the conditions are, get the proper supporting documentation, and in some cases then bring in an underwriter to analyze that documentation to make sure as a loan officer you are analyzing that information correctly. That comes up in the case of self-employed people, people who own multiple properties, who may want to use rental income, people with unusual employment histories. So when you get all of that, then you have your full pre-approval. Now, both letters say pre-approval. One is very shallow, very limited, and one is a full pre-approval. And then that loan officer is then able to, when they get that full pre-approval, to vouch for the borrower. Then, when you, Margie, take the client to contract, you are much, much more assured of having a clean transaction and going to closing. And if all that work is done up front, you can close very quickly.
Right, and we as agents, once we get an accepted offer, we call that loan person and we ask them, how much, do you have on this person? How thorough a look did you do? How good is this pre-approval?
Yep, exactly. So if I'm a buyer, I'm a borrower, and I'm not giving all of my information to the loan officer, we as a loan officer have to instruct the borrower that, I'm going to get a phone call from you or whoever the listing agent is, and they're going to ask me questions. What did I verify? If I could only tell them that I verified your credit report, that's really all it's going to say. In other words, it's not going to be as deep and as effective a pre-approval. It's not going to come across well to the listing agent that my offer is strong if I'm going against somebody else.
And we all know these days, as agents, we have multiple offers. So if somebody's pre-approval feels stronger than another, the agent's going to go with what they feel like is more of a sure thing. Another thing I think that I find with clients is that they don't realize how many different products there are for different people and different situations, and there's just about something for everyone, wouldn't you say?
Yeah, there's a lot of different products out there, and there is not one interest rate, which is a misconception because of the way the media projects or promotes mortgages in their
simplistic
reports.
Terms.
Yes, very simplistic. Keep it nice and simple. But the fact is, like you said, Margie, there are a wide number of mortgages out there, adjustable rate mortgages.
And it depends on how much you're putting down, and that affects your rate.
Exactly. So the big news in terms of rates and products this year, and it's all over the news, it's all over the internet, if you want to take a look at it, Google it, are from Fannie Mae and Freddie Mac, LLPAs, loan level pricing adjustments, which if one person has a credit score of 670, another person has a credit score of 780, you're going to get a variation in terms of product. How much money you put down, that's a factor. And for the first time ever in Fannie Mae and Freddie Mac loans, your debt to income ratio, DTI, is figuring into what kind of a rate you get. Now, the good news with all of this is Fannie Mae and Freddie Mac are putting a strong emphasis on first-time home buyers in low and moderate income areas. That is where I'm going to say favoritism, although that's maybe a slanted word, but you're definitely getting preferential treatment rate-wise if you are a first-time home buyer. So, Fannie and Freddie, that was looked upon as their mission to put people in homes years ago. That's when they were formed. So that's a positive. But what happens is there's not one rate. Then you get into other types of products for investors where there are certain investment type of mortgages out there where you don't show any income or assets. They're designed for investors. There are loan programs out there for self-employed people. So there's not one loan program out there. You have your mainstream, and that's for
And the more popular, the more well-known.
Yeah, I mean, most for Long Island, you're going to see that 75 to 80% of people are primary residence borrowers, really, or your vanilla loans, your Fannie Mae, Freddie Mac loans, and that's not everything, but that's a good portion of it. But there are a wide variety.
So I think the bottom line is that there's an awful lot to know about mortgages, and people may think they know, but I know when I speak to clients, I always say call a mortgage guy or a woman as soon as possible, because they have the best information, and you'll be blown away by the number of products and the potential that's out there. But first, talk to them. That's really the very first thing you can do. So that's it for today. Thanks for joining us.
Thank you, Margie.